Are Treasury bonds affected by a changing yield curve? Imagine a landscape where interest rates are constantly shifting, shaping the way investors earn passive income. That's what the yield curve does. It shows how interest rates on bonds of different lengths relate to each other. Treasury bonds are a big part of this picture. When the yield curve moves, it can change the value and yields of these bonds. The yield curve plots the interest rates on Treasury securities from short-term to long-term maturities. Usually, longer-term bonds have higher yields because they carry more risk from inflation and interest rate changes. This creates a normal upward sloping curve. But when the shape of the curve changes, becoming flat or even inverted, it signals different economic expectations. If the yield curve shifts upward, meaning yields increase across all maturities, the prices of existing Treasury bonds tend to fall. That's because bond prices and yields move in opposite directions. When yields go up, the market value of bonds drops. Conversely, if the curve shifts downward, yields decrease, and bond prices go up. This inverse relationship is key for investors who hold Treasury bonds for passive income. The shape of the yield curve also reflects what investors think about the economy. An upward sloping curve suggests growth and rising interest rates. An inverted curve, where short-term yields are higher than long-term yields, often hints at a slowdown or recession. These expectations influence how Treasury bonds are priced and how their yields change over time. For passive income investors, understanding this relationship is important. When the yield curve steepens, longer-term bonds might offer higher yields, boosting income. But they also face greater interest rate risk because bond prices can fall if rates rise. That's why many investors use strategies like bond laddering, buying bonds with different maturities, to manage risk and keep income steady. In the end, Treasury bonds are very much affected by changes in the yield curve. The curve acts as a barometer for the market's outlook on interest rates and the economy. When it shifts, it impacts bond prices, yields, and the income investors can expect. Keeping an eye on these movements helps passive income investors make smarter decisions about their bond portfolios.